My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to explain and educate. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. In this market, every time you stray too far from technology, especially the tech titans, you ultimately get slapped in the face by reality. And that's what happened today when the largest and arguably best performing bank in the world, JP Morgan, laid a huge egg with its forecast, telling you that the estimates are too high, maybe way too high. That spoiled a big chunk of the market, Dow ultimately dipping 93 points, S&P inching up 0.45%, but the tech-happy NASDAQ still gaining 0.84%. The past couple of months, ever since the Fed gave us the all-clear signal, we've been seeing money flow out of tech into long-neglected regions of the stock market. This is the fabled broadening out that people spent all year clamoring for. When we bring in more groups of winners, we're supposed to have a much healthier market. At least that's what they say. There are tons of financials in the S&P 500, about 13% of the index. And the strength in those stocks was a source of much mirth for everyone who'd gotten sick of the Magnificent Seven. But a funny thing happened on the way to that broadened out market. We got economic choppiness. Or to use a more accurate phrase, we got guide downs that were intolerable to any of the leaders and the kiss of death to the stock of JP Morgan. You can't be a leader when you're slashing your forecast, for heaven's sake. That's when the shareholders kick you to the curb and find someone new to follow. But today, Daniel Pinto, JP Morgan's president and chief operating officer, lowered the boom on the optimists who desperately wanted to buy something other than tech. The big bank told us that things are less robust than we thought. There isn't as much capital markets activity as we had hoped this quarter. And most important, the estimates for next year are too high because of a likely miss on net interest income, the key metric for the banks, one that analysts expect to be good when rates are coming down. In short, JP Morgan's going to miss the numbers next year. If the bell cow of finance can't make the estimates, how the heck will anyone else? So the stock comes down 5%, one point even uglier, and the rest of the banks, they roll over. It gets worse. Last year, Pinto said the company was slated to spend between $1 and $2 billion on tech. This year, JP Morgan's spending $2 billion. But a lot of that's related to cracking down on fraud. Great. That's a dead weight loss for the bank, a must spend with no real return on investment. There's an opportunity for AI to help them cut costs, especially of the 100,000 to 250,000 people in call centers or doing other back office jobs, what he calls operational things. Now, many of these people will be, quote, impacted, which I guess is code for laid off. The rest will be what he calls operational efficiencies, getting more productivity from the same people. The good news here is that at least JP Morgan will have some lower expenses over the next 3 to 5 years. Given that everything that's going the wrong way here, though, maybe someday, at some moment, there'll actually be a return on investment on AI. But you can't just say that out loud because it would require admitting that lots of dead wood is about to get chopped. And dead wood is, of course, people. Wall Street used to actually say stuff like that, but these days we're all coming up with cleaner, more indirect euphemisms. Hey, we don't do layoffs anymore. We find efficiency. We right-size the workforce. Now, is it just JP Morgan? No. Another financial that became a truly visible leader, Goldman Sachs, my alma mater, told us yesterday that its capital markets business will be down 10%. Ouch! We thought it was only going to be down 6.6%. That's a huge delta, as we call it on Wall Street. Let me translate. Business isn't nearly as good as we thought, so scrap your numbers. Now let's go back to the recently shunned sector, the bête noire of this market. Let's go back to technology. Oracle, once a slow-growth enterprise software business, just reported a truly blowout quarter. These guys pivoted a couple of years ago with founder Larry Ellison, possibly the most competitive man on earth, talking about building lots of data centers to house all that NVIDIA equipment that the hyperscalers can't get enough of. The project stalled a bit, but now he and CEO Safra Catz, another incredibly competitive person, and a dynamo, have built 162 data centers, and they're just crushing it as each data center is incrementally positive. Guess what? That's not enough. He wants to build maybe 1,000, maybe 2,000 more data centers because that's how many are needed. And Oracle's data centers will have the best security and low cost and the least mistakes. We know that they won't make mistakes because the company's staffing these monsters with nothing but machines. Each one will make more money, and the bigger they get, the higher the earnings will go, and that's why that stock shot up 11%. Technology, 11%. Hey, contrast Oracle with the debacle over JP Morgan. There's no business that JP Morgan could throw money at to produce such a huge return as Oracle can. The banking business will remain hostage to the economy, forced into having razor-thin margins thanks to all the competition. Oracle, on the other hand, is arguably in control of its own destiny. On the conference call, Ellison gave you a classic AI use case that represents the future. Listen to this, quote, I was in Stanford with my son one time, and it took three different physicians, to actually be able to find his X-rays. But in contrast, he says, this is how you find the X-rays for Larry Ellison. You say, Oracle, please show me Larry Ellison's latest X-rays. It's voice interface. You look at the computer, and it knows you're the doctor, and you're authorized to look at all the authorizations done with AI. All of Cerner is the modernization, end quote. Now, you don't have to worry about logging on. You just look at the computer. It recognizes your face or your voice. It knows what you're authorized to look at. All the authorizations done with AI's Oracle, that's this Cerner arm. But basically, that was an advertisement for Cerner on the call, but it sure made a lot of sense. I think that's a multiple $100 billion opportunity with a terrific return on investment for companies that adopt this system, not just for healthcare, but for everything. Now, Oracle makes for a great leader because anything connected to the data center has tremendous pin action. Everything from NVIDIA semis. Oh, people keep talking about NVIDIA slowing. I mean, you're just bored by NVIDIA, admit it, or you're jealous of it, because it's not either of those. It's not slowing, it's growing. So NVIDIA semis to bricks and mortar to cooling and backup power to Broadcom's network equipment. You see that stock starting to come back now, I told you. And let's not forget all the electrical infrastructure we need to power these things. The need for data centers and their construction will be with us for multiple years. That's what Ellison told us. I never bet against Ellison. They have nothing to do with Jay Powell and his Murray band of open marketeers decided next week's meeting. We don't have to play an interest rate guessing game with tech because the Fed is tangential. The data centers will get built whether rates are at 6% or 0%. Bottom line, that's how a stock like Oracle, that's up even more than JP Morgan year to date, could hit a 52-week high today while JP Morgan stock plunged. It's how you get leadership you can bank on, and I don't use that verbatimly. You simply can't bank on the bank stocks right now, hence why the great broadening out is indeed fraught with risk. Meanwhile, tech may be torturous to own on a day-to-day basis, but long-term, it's a cornucopia of rewards.
House of pleasure.
Bill in Massachusetts. Bill.
Hi, Jim. Thanks for taking my call.
Of course.
The pullback in Goldman Sachs, do you think that's a buying opportunity?
I want to wait till numbers come down from others. I was a little surprised that Goldman didn't see more capital markets. I got to tell you, David Faber and I were talking about where are the IPOs? It's September, for everybody's sake. Where are the M&A? I think that maybe the election has everything frozen, but that means Goldman Sachs numbers are too high, and therefore I don't want to make a big commitment to the stock right here, even though I love the company. John in Georgia. John.
First of all, Jim, a big booyah to you.
I like that, and I give one back to you.
And I wanted to check on the company called Vista, stock symbol VIST.
I don't know. I have Miguel's hat right on my desk. I'm liking him a lot. That's Galuccio. He's the CEO. He's into CS. That is one of the few energy companies that are holding up. That said, if oil plunges below 65, even that one is not immune. Okay, listen to me. The great broadening might hold just as much risk as the tech trade. Long term, at least, tech is a cornucopia of rewards. We have money tonight. Fresh off its Investor Day, and I'm hearing about Campbell's plan for growth, including a name change, by the way, with the CEO. And we know that snacking is a tough corner of the market, and amid the rise of GLP-1s, where does Mondelez stand in the sector? Boy, I'd like them to come on the show. I'm doing a deep dive and giving you my take. That really 130% in the last year. Could the stock of Wingstop continue to fly? I've got the exclusive, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something?